Hello, enrolled agent candidate. Welcome to our sample video lesson. We offer 30 different video lessons to help our customers as they prepare to pass the enrolled agent exam. What follows is an example of one of those video lessons. This one covering the topic basis of assets. At the end of the video, you will see a list of all the various video lessons that are available to our customers. By the way, to return to Tax Preparer Learning Systems, LLC website at any time, either go to the Open TBLS tab that should still be available on your device, or simply go to tpls.biz to return to our site. Basis of assets. The starting point to determine basis depends in large part on how the asset was acquired. During this lesson, we will look at a number of different starting points for basis. For purchased assets, the obvious starting point is the purchase price, including any sales tax. We then add various other costs, such as the cost of delivering the asset, costs of recording any legal paperwork related to the purchase of the asset, and installation and testing costs. A bargain purchase is a purchase of an item for less than its fair market value. If, as compensation for services or for other reasons, we purchase goods or other property at less than fair market value, we include the difference between the purchase price and the property's fair market value in income in most cases. The basis in the property is then its fair market value plus any amount we include in income. When we purchase a trade or business, we're generally purchasing all the assets used in the business operations, such as land, building, and machinery. We allocate the price among the various assets, including any Section 197 intangibles. If we acquire a trade or business, we allocate the consideration paid, or what we paid, to the various assets acquired. Generally, reduce the consideration paid by any cash and general deposit accounts, including checking and savings accounts received. We then allocate the remaining consideration, or the remaining purchase price, to the other business assets received in proportion to, but not more than, their fair market value, in a prescribed order, starting with certificates of deposit and ending with goodwill and going concern value. The buyer and seller may enter into a written agreement as to the allocation of any consideration or the fair market value of any of the assets. This agreement is binding on both parties unless the IRS determines the amounts are not appropriate. Both the buyer and seller involved in the sale of business assets must report to the IRS the allocation of the sales price among Section 197 intangibles and the other business assets. We use Form 8594 to provide this information. If we buy multiple assets for a lump sum, allocate the amount paid among the assets received. We must make this allocation to figure our basis for depreciation and gain or loss on a later disposition of any of these assets. If we buy multiple assets for a lump sum, we and the seller may agree to a specific allocation of the purchase price among the assets in the sales contract. If this allocation is based on the value of each asset, and we and the seller have adverse tax interests, the allocation generally will be accepted. To figure the basis of property received as a gift, we must know its adjusted basis to the donor just before it was given to you, its fair market value at the time it was given to you, and any gift tax paid on it. So in other words, we need to know adjusted basis of the donor, fair market value of the asset at the time it was given, and any gift tax paid on it. If the fair market value of the property at the time of the gift is less than the donor's adjusted basis, the basis depends on whether we have a gain or a loss when we dispose of the property. Basis for figuring gain is the same as donor's adjusted basis, plus or minus any required adjustment to basis while we held the property. Basis for figuring loss is its fair market value when we receive the gift, plus or minus any required adjustments to basis while we held the property. If we use the donor's adjusted basis for figuring a gain and get a loss, and then use the fair market value for figuring a loss and get a gain, we then have neither gain or loss on the sale or disposition of the property. In other words, we would report gain or loss as zero. On the other hand, if the fair market value of the property is equal to or greater than the donor's adjusted basis, our basis is the donor's adjusted basis at the time we received the gift, increased basis by all or part of any gift tax paid, depending on the date of the gift. The basis of property inherited from a decedent is generally one of the following: the fair market value of the property at the date of the individual's death, the fair market value on the alternate valuation date if the personal representative for the estate chooses to use alternate valuation, or the value under the special use valuation method for real property used in farming or a closely held business if chosen for estate tax purposes. The decedent's adjusted basis in land to the extent of the value excluded from the decedent's taxable estate as a qualified conservation easement. So 4 possibilities. Fair market value, date of death, that's the general rule and the one we would see most often. Fair market value on an alternate valuation date, value under special use valuation, or adjusted basis when we have a qualified conservation easement. If joint tenancy or tenancy in the entirety is the original way the property was purchased, the amount contributed by the surviving tenant is taken into consideration when determining basis. If we hold property for personal use and then change it to business use or use it to produce rent, we must figure its basis for depreciation. An example of changing property held for personal use to business use would be renting out your former main home. The basis for depreciation is the lesser of the following amounts: the fair market value of the property on the date of the change, or adjusted basis on the date of the change. So the lesser of those two amount, fair market value, adjusted basis. If we later sell or dispose of property changed to business or rental use, the basis of the property we will use depends on whether we're figuring for gain or loss. The basis for figuring a gain is adjusted basis when we sell the property. The basis for loss starts with the smaller of adjusted basis or fair market value at the time of the change, then adjust this amount for the period after the change in the property's use to arrive at a basis for loss. And then we come to adjusted basis. Adjusted basis takes into account items that happen after the initial starting point. So up to this point, we've looked at the initial starting point, all the various ways that assets can be acquired, and we've looked at what the initial starting point would be for them. After that, though, certain events may occur during the period of ownership that may increase or decrease basis, resulting in an adjusted basis. Increased basis by items such as the cost of improvements that add to the value of the property, and decrease it by items such as allowable depreciation and insurance reimbursements for casualty and theft losses. Let's look at some questions. Which of the following determines the basis of property received in exchange for services? Well, that would be the fair market value of the property received. And the way we would want to look at that is if we want to look at what we were paid for our services. And what we're paid is the fair market value of whatever property we receive. Of course, if what we receive is cash, the fair market value is simply the amount of cash that we receive. But if we receive property other than cash, we would want to look at how much that property was worth when we received it. And that would be the amount we received, the value of what we received. So it's really no different for property other than cash and cash. We're always looking at what is it worth, the item that we've just received for our services. So which of the following determines basis received in exchange for services? Fair market value of the property received. In 2015, we bought 100 shares of XYZ stock for $1,000 or $10 a share. In 2016, we bought 100 shares of XYZ stock for $1,600 or $16 a share. In 2017, XYZ declared a 2-for-1 stock split. We still hold that stock. Which of the following is correct? Well, as we can see, the basis per share of the 2015 purchase is now $5 per share. We take the $1,000 we paid for the 2015 shares. We now have 200 shares. We started with 100, but it was a 2-for-1 stock split. So we now have 200 shares. We take the original amount we invested, divide it by the number of shares we now hold, and we come up with a $5 per share basis. Same with the 2016 purchase. 2016 had $1,600 investment to begin with. We now have the 200 shares, 100 times 2, just like we had up here, 100 times 2. We now have 200 shares, so the basis per share of the 2016 purchase is now $8. And so both A, 200 shares with a basis of $5 right here, and B, 200 shares with a basis of $8 right here, both A and B are correct. We received a gift of property from our mother that had a fair market value of $50,000. Her adjusted basis was $20,000. She paid a gift tax of $7,000. What is our basis in the property? Well, this is a little bit of a challenge for us. First things first. What we have is fair market value is greater than the donor's basis. So we're essentially going to base our calculation. Our starting point is the adjusted basis of the donor. Donor's adjusted basis was $20,000. Well, that's simple enough. That since fair market value is greater than adjusted basis, we're going to use adjusted basis of the donor, in other words, the mother's adjusted basis as our starting point. The complicated piece comes in that there was a gift tax paid, and we need to determine how much of that gift tax relates to the increase in value of the property. You know, she bought it at 20. Well, it's now worth 50. So obviously the gift has increased in value. And we want to assign the portion of the gift tax, the portion of this $7,000 that relates to the increase in value. Okay, so first things first, let's figure that the increase in value is $30,000. It's now worth $50,000. Adjusted basis, or the mother's original investment, was $20,000. So the increase is $30,000. The gift tax that was paid is $7,000. We need to consider the annual exclusion. And in this, at this point in time, the annual exclusion for gifts is $15,000. So take fair market value, subtract $15,000, and we come up with a taxable amount of the gift of $35,000. We then take the net increase in value, $30,000, divide it by $35,000 to come up with 85.71%. We then take the 85.71%, multiply it against the gift tax paid, and we come up with a gift tax due to increase in value of $6,000. Take that $6,000, add it to the mother's adjusted basis, and now our basis is now $26,000. I suppose if there's a tricky part to this, it's the fact that we need to subtract that annual exclusion to arrive at $35,000, then take the increase in the value and divide it by that net amount after we took the exclusion of $35,000 to arrive at our percentage of 85.71%. And then finally, the basis in property inherited from a decedent may be determined as follows. The decedent's basis plus any inheritance tax paid. No, it wouldn't be that. Fair market value at the date of death, fair market value at an alternate valuation date. Yes, it could be either one of those. So we'll say B and C are both correct. So B or C above is our correct answer. Okay, well, thank you for listening to this video. I hope it's been helpful. What you see is a list of all of the video lessons that are available to our customers who purchase our premium package for all 3 parts. To purchase any of our study material, go to tbls.biz or simply go to the tab that's open on your device that'll take you back to our website. We hope you become a customer, and we hope we're able to help you as you prepare to pass the enrolled agent exam.